All right. Well, welcome back, folks. Welcome to the Money Wisdom Podcast, powered by Johnson Brunetti. My name is Nick Colantuono. I'm a certified financial planner up here in our Boston, Massachusetts offices. Jake, it's good to see you again. How you doing?
I am fantastic, sir. My name is Jake Doser, certified financial planner down here in our Connecticut offices.
We're glad we're back. As always, we've got a fantastic episode today, Jake. We are talking about debt. And as we're all aware, debt comes in many shapes and sizes, many forms. There's good debt. There's bad debt. There's no debt. So let's talk about it because it's really critical, right? People approach retirement and they think, okay, my income's going down. I want my expenses to go down. One of the biggest way to reduce expenses is by eliminating debt.
Sure.
But as we see, that might not always be the best thing. So we'll talk about it because, again, all debt is not created equal. So tell us some of the good debt that's out there, Jake.
Yeah. I mean, the thing that with good and bad debt, there's kind of two ways to think about it. It's what am I paying for? And then it's also what's it costing me? So I think at a highest level, I think it's less about what you're paying for, and it's more about what it's costing you. Generally speaking, if you can get an interest rate of 5% or less, I would consider that good debt. I guess maybe I can add a third category: good debt, okay debt, and bad debt. If you're at 4% or less, I think that's good debt. Especially right now when banks are paying around 3.5%. That means I can get a risk-free rate of return equal or similar to the interest I'm paying. Then okay debt, I suppose, would be 4 to 6%, where, okay, I'm probably not getting that much interest without risk, but at the same time, it's not crushing me in payments. And then bad debt being anything, in my mind, over 6%. All right, now we're paying out probably a lot more than my long-term investments or even advertising. I think right now, we're at the end of 2025. People are seeing the market do really strong things, and that equals to recency bias, where people are so fixated on, well, the market's up 17% in the past 12 months. And they think, oh, well, I don't mind bad debt. It's like, well, keep in mind, that's not a long-term rate of return. That's a short-term rate of return. Don't be tricked into thinking, oh, the stock market always goes up. Because right now, let's face it, you could take a dart and throw it a board blindly and make money in the stock market. The measure of wise financial decisions is not what have you done for me recently. It's what are my long-term patterns of success. And so that's kind of how I would quantify good versus bad debt. More specifically, when you're thinking about good versus bad debt, I think about also what am I buying? A loan on a house is an appreciating asset. That is a much more constructive payment versus a loan on a car or a mobile home, which is a decreasing asset, or worse yet, on a credit card, which is an indication that you're living monthly beyond your means, right? So, don't think that paying off your debt or quantifying debt puts you in a position where all your problems have gone away. Because if you're spending too much on a monthly basis and you're outliving your, pace of life affordability, well, then even if you have no debt, it doesn't mean you're not still spending too much money. So yes, that's the first thing that should be cut. The fat should be cut from in your budget, but it's not the only thing. So look at this in the larger context.
Yeah. And, I was meeting with a client late last week. It was like Tuesday, Wednesday, and she's retired. She's single. She's basically living on a fixed income and taking some assets out of her retirement accounts each and every month. And she still has a mortgage on her house. Her mortgage is like nothing crazy. Her interest rate is fantastic. Her interest rate's like 3.5%. She's like, Nick, should I pay off this mortgage? I'm like, well, you have the money to do it, but I wouldn't recommend it because keep in mind, if she's taking that money out of retirement accounts where it's going to hit her as income as a single tax filer, that could have implications on her Medicare premiums. Not only that, she would have to be withholding, 17, 18 cents per dollar of what she takes out for taxes.
Yeah.
The juice wouldn't be worth the squeeze. And on the flip side, having that mortgage, one, it's affordable. Two, it's a great rate. Three, the house is going up in value. And at the same time, that mortgage is one of the few things that actually gives her some sense of deductions in retirement. So, that was one of those situations where it's like, yeah, you don't have to have this mortgage, but you also shouldn't get rid of it.
Yeah.
Right. Because we look at the money in the market, as you talked about, and it's on fire. And sure, recency bias, the rising tide is lifting all boats, but at the same time, that's one of those really good examples, Jake, of what, good debt looks like. It's not like she owes, 25 grand on a, airline credit card or something at 22% because she's
Right.
traveling and all this stuff. That's not it. So,
Well, I think that's
yeah.
a great example. And I mean, I can piggyback on that a little bit. I had a client, we see a lot of people here in New England. See a lot of people move south, right? And so I had a client move down to Myrtle Beach, and low taxes, slower pace of life, et cetera. Totally get it. And, against my advice, said, hey, I want to pull money out and buy this next house in cash. And sure enough, now he's mortgage free, but he doesn't have a lot of assets, and it makes him nervous. And even if it didn't make him nervous, it puts him in a position, where he's at now. He is, and I've seen many people do this, he is now house rich and cash poor. And so the question becomes okay, yeah, you don't have a payment and it's maybe more convenient, but now you're in a position where if you have an emergency, you either got to get rid of the house, you got to take a loan against the house, or worse yet, you got to take a reverse mortgage so you can not run out of money to maintain your lifestyle. So there's a balance element to this, which is Nick mentioned, you have to think about the functionality of your assets with a good interest payment, but you also have to think about the liquidity of your assets. In retirement, it's better to be more liquid, not less. And so don't put yourself in a position where I've always been told, generally speaking, it's not a good idea to have a mortgage in retirement. Well, general rules of thumb are good things to, target, but they're not good things necessarily to base all your decisions around. There needs to be a balance with these things. So measure twice, cut once, folks.
Yeah, you're absolutely right. That's good advice. So when we talk about bad debt, right, as you mentioned earlier, bad debt is essentially debt that is used to finance purchases that aren't really doing anything for you aside from providing maybe some short-term gratification. When we talk about the good debt, right, it's maybe investing in education and you have to take out loans to do that. Okay. Investing in a home where, sure, the house is going to appreciate and you're going to have a place to live and all that. But when we look at the bad debt, the most common is as we talked about, credit cards. And I understand, folks, it's easy to get, ahead of yourself or a little over the skis, if you will, because let's face it, I mean, the world we live in is just more and more expensive. And as folks approach a phase of life where, maybe the writing's on the wall, health might be going downhill, if not today, but maybe within the next 5 or 10 years. And you want to do the things that you've always wanted to do while you can do them. And sometimes that means over leveraging yourself from an expense standpoint. And again, it's a slippery slope. And I was kind of shocked to see this. The average American, Jake, has, right around $6,500 in credit card debt, which might, not sound high, obviously in this area where we live in, but, generally speaking, that's a lot of money to owe, right? And then to always be sort of playing catch up and making minimum payments and just never really actually chipping away at the larger issue. We've seen folks get in trouble, haven't we?
Oh yeah. I mean, and $6,500 in credit card debt, think about it conservatively, that's a 20% interest rate. You're talking about $1,300 a year in interest-only payments, not on principal. With a credit card, you got to keep in mind, folks, is that when they send you the payment, this might be commonplace knowledge for some of us. When they send you the required payment, typically it's no less than 1.5% of the principal balance. Sometimes it's as high as 3% of the principal balance. So that means that a majority of your payments going towards interest. It's not really going towards principal. And so you're in a situation where 20 to 30% of interest looks like $1,300 to $1,950 in interest a year per year, which is $150 to $200 a month almost. That's like a small car loan for like a 21-year-old. I mean, that's just crazy, and that's an indication that you don't necessarily have too much debt, but you have too much spending, and so that's a cash flow issue. And so, that is, how do we mitigate that? Well, now we need to take a deeper dive in your spending habits. We need to look at, your budget is how can we identify how much you can truly afford. And in retirement, your budget's not just based on your guaranteed incomes like Social Security and pension. It's also based on how much your portfolio can safely generate or you should count on your portfolio being able to generate in the good and the bad years. And so there maybe is a greater conversation here where we need to talk about priorities. We need to think about what is this lifestyle creating, and certainly don't go into debt when you got money that you could be paying debt off with, to an extent.
When it comes to the bad debt, right? Obviously credit cards, personal loans, again, things that are buying assets that won't necessarily appreciate. They typically come with higher interest rates, which means higher interest only payments before you're even touching the principal. So again, really try to avoid that. And the way we do that, as you're aware, create a budget, work to improve your credit score, because if you do find yourself in a position where you need to get your hands on money and you don't have access to that capital through your own assets, you need to go out and get debt. Well, having a better credit score is going to make you a more credit worthy contender for these loans. So little things mean a lot. Building an emergency fund, making sure that you do have those safety nets in place where if something comes up, your immediate response isn't to go get a loan to pay it. Plan for these things. So talk with your advisor, talk with whoever you're working with when it comes to this stuff. Really work on those expenses. Get a feel not only for what's coming in, but what's going out. And then, Jake, as you mentioned, what assets you have to make up that difference. God forbid anything unfortunate were to happen to you. So one of the easiest ways, folks, to start this conversation is by getting our guide. We've got a kit, in fact. It's called the Are You Ready to Retire Starter Kit. We want everybody listening, we want everybody watching to get that, because it's really going to help you address, well, do I have an appropriate plan in place if an emergency comes up? Or should I be paying off my mortgage? Or should I really go attack the car loan or the credit card loan or the points on my travel credit card or something like that? So again, folks, we want everybody listening and everybody watching to get this kit. It's the Are You Ready to Retire Starter Kit. Text the word KIT, KIT. Text it to us at 800-757-0436. We'll get that kit out to you in the mail. Once again, KIT, KIT. Text us at 800-757-0436. So there's good debt. There's bad debt, right? As we mentioned, comes in all different shapes and sizes.
And Nick, let me just say, I think that it's important for folks to enter retirement with the right mindset around debt. Can you retire with debt? You certainly can. We see it more and more. There's this old adage that you have to have the mortgage paid off before you can retire. That's not necessarily true. You have to manage both the interest rate. You have to manage your cash flow, and your monthly payments. I just got out of a meeting this morning where a client, and rightfully so, is prioritizing a lower interest debt option item to pay off first before a high interest debt option. You might say, well, whoa, shouldn't they pay us high interest first? Well, in this instance, because they're paying them off both over in the next 3 years, by paying off option number one, lower interest, the payment is so much higher that once they're out from underneath that, it gives them the freedom to make extra payments, to catch up on the savings in the bank they haven't done before, and feel like they're accomplishing something. So you feel like you have to know yourself. There is a lot of instances where mathematically the answer is you can afford, like Nick mentioned, to pay this mortgage off. But should you? That's a different question. And so a lot of times what we're working with folks when they have multiple pieces of debt is, hey, as you go into retirement, here are priorities, number 1, 2, and 3 of what we should be paying off first. How should we balance paying debt off and also building up an emergency fund? And as Nick mentioned, going into retirement, you need a credit score that's strong, just like in your working years. Well, I have no intention to borrow money. Why do I need a strong credit score? Because you don't know what might come as an emergency. And it's better to have a strong credit score and get a lower interest than not prepare for it because you think you'll never need credit and then you're not prepared. Another reason I recommend to some of my clients to have a home equity line of credit going into retirement. That doesn't mean that they need to borrow against it. It just means that, hey, why don't you set up a line of credit? It'll be the cheapest way for you to borrow money if you had to. And then it's there if you need it. And if you don't, fine, we just won't even use it. But of course, that's only wise if you know yourself and you can handle the responsibility of balancing that. Just like your credit card. Is a credit card evil? No. But if you feel like a credit card will encourage you to spend more money, maybe don't use it. But if you won't feel that temptation, make sure you get some cash back, right? So there's a balance with all these things, with your behaviors, with the priorities, and with the finances. And that's why a well-tuned plan will really inform the right decisions to make.
It's well said. It's a puzzle, isn't it? Right? Retirement planning, financial planning. You get the puzzle, you open it up, you dump it all in, and it's just a big pile of pieces, right? But you need to take a step back. You need to be very methodical and well thought out about how all those different pieces fit together, because as you know, it makes a beautiful picture when it's all said and done. So here we are, Jake. We're back at our mailbag minute. So we've got some great questions for you. These questions are all relating to debt. So viewers, listeners, thank you for sending us these questions. Keep them coming. First, let's answer a great question about mortgages. And this one, something that you touched on earlier in the episode, Jake. When should I take a reverse mortgage?
So, most folks who are listening are like, reverse mortgage, don't do it. And generally speaking, I am all for being extremely cautious around reverse mortgages. There's a history of reverse mortgages about being very predatory, especially in the senior community. And so what I would encourage you to know is, number one, after the 2008 housing crisis, the reverse mortgage industry was extremely scrutinized. And now folks have to go through an educational process. And a reverse mortgage is not all that dissimilar to a home equity loan nowadays. The older you are, the more equity you can draw out of it. And you sometimes have, depending on how the reverse mortgage is structured, you might have payments back, like a home equity line of credit. You might just get monthly payments. They're not always evil. They are typically something of last resort, we recognize. Of the hundreds of clients I have, I've only recommended one ever. And it was because somebody refused to change their spending habits and needed to have something to bail themselves out. So should you count on using a reverse mortgage? No. But if your house is the largest piece of equity and for some reason you're unwilling or unable to sell it, that might be an instance where using a reverse mortgage makes sense. But don't do that without talking to a financial professional.
Yeah, you're exactly right. I mean, typically we see, people do have a lot of equity in their homes, and it is a large asset. And if you need access to the equity, then, there are options out there to take it. But big decisions that need to be made, critical conversations that need to be had before you go down that road.
That's right.
Not that it's a bad option. It's in fact, it can be a great option if it's the right fit. So have those conversations. Next, we have a question about retirement, income, timing, and taxes. This one's going to be a party. If my husband plans to retire on December 31st, he'll get a payout of unused sick and vacation time. With this lump sum, will he be taxed in 2025 if he doesn't receive the money until 2026?
Good question. I mean, taxes are due in the year in which they're received. So, yeah, I mean, if he's owed it in 25, but he doesn't receive payment until 26, then it should be a 2026 thing. Now, if that payment is delayed until 2026 because the bank had the money and the check hadn't cleared yet, that's different than their direct deposit actually going in 2026. So just be aware of that. You want to watch the 99 or the W-2 that comes out generated from that job. And if tax withholdings haven't been made, just be aware that estimated tax payments are due on income in the quarter in which it's received, not even the year. So just be aware of that. Make sure you coordinate with your financial advisor and or accountant.
Finally, a little more general question for you. Let's address a hypothetical. If I won a large jackpot, Jake, should I create an estate for the winnings? A shell company, if you will.
An estate's already created for you by the government, whether you want it to or not. An estate is your legal representation from passing from death to the people who get your money. So you don't need to create an estate, but I understand what the question is the spirit of it is like, what do I do with it? Do I do all this one step at a time? First, breathe. You probably shouldn't do anything for the first 30 to 45 days after you win that. Yeah. Certainly don't tell your family about it, because now you're getting every brother and cousin that you never heard of asking you for money. Number two, you need to sit down with a financial planner to help you figure out, what do I do with this money first? Because so many people overwhelmingly blow that money. They do not create generational wealth with that money or use it wisely, even if it isn't passed to the next generation. So slow down, take a breath, keep it under your hat, go talk to somebody. Don't let them sell you a product. Make a plan first.
Amen. Amen. Such is the topic of our beautiful podcast here. Make a plan. First things first, take a breath. Second thing, Call Jake. Make a plan. So here we are, folks. We've reached the end of another episode. And again, we want everyone to get our Are You Ready to Retire starter kit. Text the word KIT, K-I-T. Text it to us, 800-757-0436. We will get that kit out to you ASAP. 800-757-0436. Text the word KIT to the team. And again, we want you to approach this next phase of life with all the clarity and confidence you need to make these critical decisions. So, Jake, thank you as always, my friend. Pleasure talking with you. Thank you for your advice. Viewers, listeners, we really appreciate you joining us again on yet another episode of the Money Wisdom Podcast, powered by Johnson Brunetti. Again, I'm Nick Colantuono, certified financial planner up here in Boston, and I'll sign off for you, Jake, as well. Jake Doser, certified private wealth advisor and certified financial planner down in our Connecticut office. We'll see you next time. Thank you.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.